Hi, this is Robert Perez from Bias Investors. All investments derive from three basic asset types. First of all, there's cash, most frequently in the form of balances at the bank. Cash, when held at the bank, is essentially a loan to the bank, which they in turn lend out to other clients at a profit margin. For the purpose of investment speak, we refer to any loan which an investor can call back in less than 12 months, cash. Other forms of cash would be Treasury Bills. These are obligations of a government, all of which are issued at a discount to its maturity value, paid in full within 12 months. Another asset type is bonds, otherwise known as fixed income securities in North America or fixed interest securities in the United Kingdom. They are securitized loans with a maturity of more than 12 months. In fact, some governments have issued bonds which mature as long as 40 years in the future. However, because of today's historically low level of interest rates, individual investors are unlikely to buy bonds with maturities in excess of 5 to 7 years. The third asset type is equities. These are the most exciting asset class because it represents ownership in a company which entitles the investor to a share of the company's profits. In North America, equities are referred to as stocks, whereas in the United Kingdom, they are called shares. The higher the profits, the greater the appreciation of the stock price. The opposite is also true in that should profits decline, so would the price of the stock fall. Generally, stocks and shares provide greater but not predictable returns, whereas bonds and cash provide much lower but very predictable returns. As you build your wealth, always remember that financial investments always derive from three basic asset classes: cash, bonds, and equities.